Today's highlights: prices rise, but profits lag, leverage cools down, and long-term holdings are locked in. Bitcoin plunged 40%, yet ETFs absorbed 2.5 billion. Even cold wallets were breached, completely upending crypto logic. Reshaping value systems with digital assets, tracking 24-hour crypto trends, and elevating wealth through insight. Wednesday, March 25th. This is Dong Dong from BitcoinTV's Chinese channel. Let's look at the most important crypto data headlines from the past 24 hours. This data shows that while prices are rising, profitability isn't keeping pace. The NUPL metric tracks overall market profit. Surprisingly, as Bitcoin hit $126,000, it failed to reach a new high. It actually formed a lower high, which is a bit awkward. It looks bullish, but the profit effect is weakening. After a subsequent correction, NUPL dropped steadily, hitting 0.17 on the weekly chart. This means many went from unrealized gains straight back to unrealized losses. We've seen this structure before, like in May 2022. First, leverage is removed, then sentiment is flushed out. Simply put, the market is redistributing the pie. Early profits are being absorbed, while the cost basis for newcomers is being reset higher. This phase is called repricing. Also, this indicator is now viewed via candlestick charts, showing a range of volatility rather than just a single point. It more clearly shows if the market is recovering or bleeding out. Currently, the derivatives pressure index has dropped to around 25 to 26%, which is essentially a low level, yet Bitcoin remains steady, near $70,500. This highlights a key point. This rebound wasn't driven by increased leverage. Instead, it rose gradually while most were hesitant to bet. Previously, it bounced from $67,000 to near $70,000, even as the pressure index continued to fall. This kind of divergence is rare. Essentially, the market is deleveraging rather than fueling hype. In the past, a price rise meant a crowd rushing in. Now, there are fewer people, yet the price keeps climbing. This state usually means risk is being cleared and the market is becoming cleaner, making volatility more controllable. This type of market isn't exciting, but it's often healthier. This on-chain data makes it clear short-term players are exiting and veterans are taking over. Those who bought Bitcoin in late 2025 have now held for over 155 days, upgrading from short-term traders to long-term holders. These coins aren't moving, effectively locked away, which naturally reduces the circulating supply. When short-term traders dominated, the market swung wildly every day with high trading frequency and heavy sentiment. Now, with long-term capital in control, the pace has clearly slowed and the structure is more stable. Historically, this shift often means the market is moving away from short-term speculation and into an accumulation cycle. People aren't rushing to sell, they're gradually gathering chips. Over time, as supply tightens, control over price slowly shifts to long-term investors. Please like and subscribe. We'll monitor the news for you 24/7. This channel takes a macro perspective, providing 15-minute deep dives to help you quickly grasp major changes in digital assets and broaden your understanding. Now, for today's news, many people are still looking at the market through a very outdated lens. They think if prices drop, capital must be fleeing. But this time is totally different. Prices are down nearly 40% over the last 6 months. Yet the real big money hasn't left. In fact, it's steadily flowing in. What does this mean? It means the market's power players have changed. It's no longer driven by retail, but by institutional positioning. ETFs are the clearest window into this. You're not seeing short-term speculation, but long-term positions being quietly built. So just looking at the price won't tell you the whole story now. You have to follow the money flow. As I see it, as long as money is coming in, the story is far from over.
According to Bloomberg ETF analyst Eric Balchunas, spot Bitcoin ETFs saw about $2.5 billion in inflows in March, nearly erasing the year's outflow gap. Meanwhile, IBIT has entered the top 2% of all U.S. ETFs for capital inflows. Notably, all of this is happening despite Bitcoin dropping about 40% over the last 6 months.
I believe Bitcoin is legitimate. I'm not trying to say there's not bit misuses like everything else, but it is a legitimate financial instrument that allows you to have maybe uncorrelated, non-correlated type of returns. I believe it is an instrument that you invest in when you're more frightened, though. It is an instrument when you believe that countries are debasing their currency by excess deficits.
Balchunas noted that when gold dropped about 40% 10 years ago, roughly 1/3 of investors chose to redeem their holdings. In contrast, this round of Bitcoin ETFs has seen almost no large-scale withdrawals, with capital flowing back in quickly instead. This demonstrates a much stronger commitment to long-term holding among institutional investors.
What you should really watch out for isn't a market drop, but a market that refuses to drop. Think about it. The price is trending down, yet capital is still pouring in. What does that tell you? It means there's a deeper logic at play. ETFs aren't for retail games, they're tools for asset allocation. Who's behind them? Pension funds, institutional capital, and even sovereign wealth funds are all gradually building positions. In other words, this isn't hype, it's price discovery. The future market rhythm might not be wild swings, but a steady lift by capital. If you're still using old bull and bear logic to judge the present, you're very likely to miss out on the gains. They're buying aggressively. Think companies are buying Ethereum just to bet on the price? Wrong again. The game now is making money work for itself. Bitwise's continuous accumulation might look like simple hoarding, but they're actually building an on-chain yield system. In the past, companies hoarded coins like digital gold, just waiting for appreciation. But Ethereum is different. It can be staked to generate steady returns. You benefit from volatility while collecting cash. It's the best of both worlds. Simply put, this isn't just buying crypto anymore. It's moving the balance sheet directly onto the chain. So, who will master this logic first? Whoever redefines how companies should allocate their crypto assets.
According to Block Temple, Bitmain's latest disclosure shows its Ethereum holdings have reached about 4.6 million coins, with total assets exceeding $11 billion, accounting for about 3.8% of the total ETH supply. And it continues to expand its holdings, showing that institutional-grade capital is strengthening its long-term allocation to Ethereum.
Wall Street now is going to be building its entire infrastructure onto the blockchain, and the blockchain they're choosing is Ethereum. So this is the 1971 moment where Wall Street is essentially capitalizing on tokenizing the entire world onto a blockchain. That's a huge opportunity.
Currently, about 3.14 million ETH from Bitmain is staked, accounting for about 67% of its holdings. Based on the current annual yield of about 2 to 3%, the annual revenue could reach the $100 million level. At the same time, the company is promoting a validator network to optimize its revenue structure. This indicates that ETH is transforming from a single price asset to a yield-bearing on-chain asset.
Let's look a layer deeper. The competition between companies is no longer about who buys more, but about who can turn an ETF into a money-making asset. In the past, hoarding coins was about whether the price would rise, but now traditional finance has entered the market, stablecoin yields are being restricted, and the era of easy money is completely over. The US CFTC is personally getting involved in innovation, and crypto regulation has taken a complete turn. Making money steadily? Wrong. US regulators have flipped the table this time. The harshest blow of the Clarity Act isn't restricting trading or issuance. It's that they've directly targeted the yields. In short, the path of just holding stablecoins to earn interest is likely a dead end. Because this has touched the core lifeblood of banks, deposits. To put it simply, stablecoin yield isn't a technical issue, but a matter of financial power. That's why as soon as this bill came out, banks, exchanges, and policymakers all clashed head-on.
The Draft Clarity Act proposes to prohibit institutions from paying interest or yields to users solely for holding stablecoin balances. This direction mainly targets stablecoin yield products on exchanges and platforms, while allowing incentives based on transactions, payments, and liquidity. The core lies in distinguishing between passive income and usage incentives,
which is the second largest stablecoin out there. And as you mentioned, the interest rates in this environment, that's been both a good source of revenue for us, but it's also something that we've passed along to customers. So customers can actually earn rewards on USDC and get access to some of these higher interest rate environments.
The core driver of this restriction is the risk of capital outflow. Analysis shows that if stablecoin yield mechanisms persist, they could impact trillions of dollars in bank deposits. Meanwhile, some platforms offer stablecoin yields between 3 and 5%, exceeding traditional savings rates. This interest gap is seen as weakening the banking system's capital base.
If you break this down, it's clear. This isn't about regulating stablecoins, it's about controlling where the money flows. Before, users kept money in banks. Now, they swap it for stablecoins for yield. Simply put, they're competing with banks for deposits. If this trend keeps growing, the foundations of traditional finance will be shaken. So, what regulators are doing now is simple, blocking the path to easy passive income. In the future, if you want yields, fine. Go trade, use it, or participate. Don't just sit there. To be clear, stablecoins won't vanish. Over the past few years, everyone's gotten used to one thing. Whenever regulators step in, the crypto market usually takes a hit. But now, the tide is turning. This time, the US CFTC isn't here to attack, they're here to help. You could say regulators are no longer just referees. They're starting to help write the rules of the game. Why the sudden change? It's simple. The crypto market is now too big to ignore. Plus, if the rules are unclear, capital will just flee to other countries. The core shift here isn't policy easing, but regulators actively embracing innovation, moving from risk prevention to securing the future.
Michael Selig, chairman of the U.S. Commodity Futures Trading Commission, or CFTC, announced the formation of an Innovation Advisory Committee. Comprised of financial institutions, tech firms, regulators, and academia, the committee aims to create clearer regulatory frameworks for emerging tech like crypto and AI. With over 30 industry executives involved, the committee will directly influence the future direction of policy.
As a regulator, it's not my job to tell them what's a hedge and what not's a hedge. That said, some of these products maybe are more for speculation, more for, entertainment. The markets aren't designed just for hedgers or just for certain things that have, risk management aspect to them. Derivatives are derivatives. We have broad authority over derivatives, and we regulate the markets for derivatives.
The CFTC stated clearly, the committee will focus on the impact of blockchain, AI, and cloud computing on financial markets, crafting future-ready rules to establish a clear regulatory path for the market. Plans also include involving executives from institutions like Gemini and NASDAQ to strengthen the link between policy and the market.
The key takeaway here isn't how much policy has changed, but that regulators are changing their approach. Before, they let you run and then stepped in. Now, they're drawing the lines as you go. This is actually good for the market. The scariest thing isn't regulation, but uncertainty. Once rules are clear, big capital will feel safe entering. Crypto is being pulled into the financial system. The upside is stability, but the cost is that the Wild West days are over. So this isn't really good or bad news. It's just crypto growing up.
Look-on-Chain spotted a whale, transferring about 5,000 Ethereum to an exchange that day, roughly $15 million. Opinions on X are already split. Some are calling it a dump, while others say it's just rebalancing. CryptoQuant data shows Binance had a single-day net inflow of over 10,000 Bitcoin, about $700 million. When fund movements of this scale occur, market sentiment fluctuates significantly. On-chain data shows Base Network's daily active addresses surpassed 1 million, hitting a record high with discussion on X heating up fast. After Layer 0 announced airdrop rules, many active users were excluded, leading to a surge of complaints on X as the controversy grows. Tether data shows USDT circulation surpassed $100 billion, accounting for over 70% of the market. Funds continue to flow into the stablecoin ecosystem.
Now, many people are anxious because they're still viewing the AI agent era with a human-centric mindset. In the past, everyone competed on ability, doing as much as your skills allowed. But now, the real gap lies in whether you can make things happen automatically. The essence of AI agents isn't to replace your work, but to help you amplify your leverage of choice. You're no longer just an executor, but a designer of systems. In the future, the most valuable people won't be the hardest workers, but those best at building systems. No matter how hard you work, you can't outcompete someone who uses AI agents. You start to realize that efficiency growth isn't linear, but an exponential shift. Many people are still asking, what should I do? But the more important question is, can I make those things happen automatically? Can I make them run on their own? When you shift from being a doer to a system orchestrator, your position has already changed. Remember, you're not working harder. You're starting to let the system work hard for you. All right, that's the main content for this episode. This channel focuses on core narratives and value discovery in the digital asset space. If you agree with our logic, feel free to stay updated with the latest info and turn on real-time notifications. To access higher-level research reports, please follow our advanced channel. From Monday to Friday, I'll share my deep reviews of market cycles to capture certain opportunities within trends. See you tomorrow.